You're checking your monthly mortgage statement and you see it, your interest rate locked in years ago. Then you open up a news article or hear a friend talking about the great rate they just got on their refinance. A little voice in your head starts whispering, "Can I be saving money too?" Refinancing your mortgage is one of the most powerful financial tools available to a homeowner, but it's also one of the most misunderstood. It's not a magic wand, and it's not free. Doing it at the wrong time or for the wrong reasons can actually cost you tens of thousands of dollars. So how do you know if it's the right move for you? What's the real math behind the decision, and what are the hidden pitfalls you absolutely must avoid? In this guide, we're going to move beyond the simplistic rates are low, you should refinance advice. We're going to build a complete financial framework for evaluating a refinance. You'll learn the 3 core strategic reasons to refinance, how to calculate your personal break-even point down to the dollar, and the step-by-step process of how it actually works. By the end, you'll have a clear, numbers-driven method to decide whether picking up the phone to a lender is a stroke of genius or a costly mistake. Let's start by defining what a refinance actually is. In its simplest form, to refinance your mortgage means to replace your existing home loan with a new one. You go through a process very similar to when you first bought the house, applying, underwriting, and closing. The new loan pays off and cancels your old mortgage. You are then left with a brand new loan with new terms. People pursue this for 3 primary strategic reasons, and understanding which category you fall into is step 1. The first, and most common, is the rate and term refinance. The goal here is purely financial optimization to secure a lower interest rate to change the length or term of your loan, or both. For example, you might refinance from a 30-year loan at 6% that you've had for 5 years into a new 30-year loan at 4.5%. Your monthly payment drops significantly. Or you might refinance from a 30-year loan into a 15-year loan. Your payment might go up, but you lines pay far less interest over the life of the loan and own your home twice as fast. This type of refinance is about improving the efficiency of your debt. The second major reason is a cash-out refinance. Here, you are tapping into the equity you've built up in your home. Equity is the difference between your home's current market value and what you still owe on the mortgage. In a cash-out refinance, you take out a new loan that is larger than your existing mortgage balance. You use the new loan to pay off the old one, and you get the difference in a lump sum of cash at closing. People use this cash for major expenses like home renovations, paying off high-interest credit card debt, or funding a child's education. It's attractive because mortgage interest rates are typically much lower than credit card rates. However, this is a serious decision. You are converting unsecured debt into debt secured by your house, and you are resetting the clock on your mortgage. The third reason is less common but important: to remove private mortgage insurance (PMI). If you originally put down less than 20%, you're likely paying PMI. If your home's value has increased enough that you now have 20% equity based on a new appraisal, a rate and term refinance can get you a new loan without PMI, reducing your monthly payment. Now, let's tackle the single most important calculation in any rate and term refinance decision: the break-even point. This is the moment in time when your total savings from the new loan surpass the total costs to get it. Refinancing is not free. You will pay closing costs, which typically range from 2% to 5% of the new loan amount. These include appraisal fees, origination fees, title insurance, and other third-party charges. Let's dive deeper into the term change strategy, because this is where people often make emotional rather than mathematical decisions. Refinancing from a 30-year to a 15-year loan is a fantastic wealth-building tool, but it's not for everyone. The upside is massive. You lines pay off your home in half the time and save a fortune in interest. For example, On a $300,000 loan at 4%, switching from 30 to 15 years could save you over $100,000 in interest. The downside is the higher monthly payment. You must be absolutely certain your budget can handle that increased payment for the next 15 years. A more flexible alternative is to stick with a 30-year loan and make extra principal payments equivalent to a 15-year schedule. This gives you the same payoff timeline, but the safety net of a lower required payment if you hit financial hardship. The refinance locks you into the higher payment. Discipline gives you options. For a cash-out refinance, the analysis is different. The question isn't just about break-even on payment, but about the use of the capital. Using home equity to consolidate high-interest credit card debt at 20% into a mortgage at 6% can be a brilliant financial move. It simplifies your bills and saves on interest. However, the deadly mistake is treating your home like an ATM. If you cash out to fund a lavish vacation or a new car and then run up the credit cards again, you've simply dug a deeper hole and put your home at risk. Another critical warning, a cash-out refinance will reset your amortization schedule. If you've been paying a 30-year loan for 10 years, you're 10 years into paying it down. A new 30-year loan resets you to year one. Even at a lower rate, you might be extending the total time you're in debt and increasing the total interest paid over the very long term. You must run the numbers for your specific scenario. The practical process of refinancing mirrors a purchase loan. You'll need good credit, usually a minimum score of 620 to 640, but 740 for the best rates, stable income, and a debt-to-income ratio typically under 43%. Your home will need to appraise for a value that supports the new loan. One insider secret is that your current lender is often not your best option. Shop around. Get quotes from at least 3 different lenders: a major bank, a credit union, and an online mortgage company. Compare not just the interest rate, but the annual percentage rate APR, which includes fees and the detailed closing costs. Once you choose a lender, you'll lock your rate, submit documents, go through underwriting, and close. The entire process can take 30 to 45 days. And remember, a refinance will result in a hard inquiry on your credit report and will slightly lower your credit score in the short term, so don't apply for other new credit during this time. In conclusion, refinancing is a powerful but nuanced financial surgery. It should be driven by a clear goal and cold, hard math. For a rate and term refinance, calculate your break-even point religiously. If you plan to move before then, it's likely not worth it. For a term reduction, ensure your financial foundation is rock solid enough to handle the higher payment. For a cash out, have a disciplined, wealth-building plan for the money, not a frivolous one. Never refinance just because someone tells you rates are low. Refinance because the numbers, aligned with your personal goals and timeline, unequivocally tell you to. Your mortgage is likely your largest liability. Managing it strategically is a cornerstone of building net worth. If this framework helped you think more clearly about this big decision, make sure you're subscribed. Next, we lines tackle a much tougher topic: what to do if you can't make your payments and how to avoid foreclosure. Now, go pull your latest mortgage statement and start running your own numbers. The answer is in the data.